Welcome to Furniture Industry News. Today is May 7th, 2026. I'm glad you're here. Let's get into what matters this week. The first quarter of 2026 just finished telling its story, and it's one of the more revealing earnings seasons this industry has seen in a while. Not because any single number is dramatic, but because the gap between companies gaining ground and companies losing it has never been more obvious. The industry is splitting, and which side of that split you're on has a lot to do with decisions that were made long before this quarter started. Let's start with retail, because that's where the most instructive story is playing out. Havertys posted net sales of about $189 million in the first quarter, up just over 4% versus the same period last year. That makes 3 consecutive quarters of positive comparable sales growth. Their average ticket climbed nearly 12% to around $3,700. And that happened while foot traffic was actually down low single digit, but those who did spend more. Their design program accounted for 35% of written business, with designer average tickets running more than double the store average, around $8,300. Custom special order upholstery rose over 10% and now makes up more than a third of their upholstered business. Bob's Discount Furniture also had a strong quarter, reporting revenue up 8.5% to $578 million. The driver there was a deliberate move into better-tier products, mixing up the assortment toward higher price points, combined with lower freight costs and stronger protection plan margins. They opened 5 new stores and now operate 214 locations across 26 states. On the other side of that ledger, Lyons Furniture Group in Canada, which runs Lyons and The Brick, saw same-store sales fall 4.2%, and total revenue declined 3.8%. They cited macro headwinds, a cautious consumer, and delivery timing.
The difference between these outcomes isn't luck, it's strategic positioning. Havertys built a service and design infrastructure that converts higher value transactions when customers show up. Bob's built a better tier assortment that generates more margin on each sale. Both strategies are performing in an environment where volume is harder to come by. The traffic-dependent commodity model is the one that's getting squeezed. Now let's talk about bedding, because there are 2 very different stories happening at the same time. Somni Group International, which owns Tempur-Pedic and now Mattress Firm, had a strong quarter. They swung from a net loss of $33 million a year ago to net income of over $104 million this quarter. Total sales climbed 12% to $1.8 billion. A lot of that reflects having a full quarter of Mattress Firm revenue versus only about 55 days in the prior year comparison. On an adjusted basis, earnings per share rose 20%. The company also announced a pending $2.5 billion deal to acquire Leggett & Platt, the industrial components manufacturer. That deal is expected to close by year-end. Leggett & Platt itself told a different story. Sales fell 10% to $918 million in the quarter. The domestic bedding business was weaker than expected, and the company estimates the U.S. mattress market declined somewhere between high single and low double digits in the quarter. They cited weather-related closures, lower consumer sentiment tied to the conflict in Iran, and rising fuel and transportation costs as key pressures. What you're seeing in bedding mirrors what you're seeing in retail. Vertical integration is performing, while standalone operators face more structural headwinds. When Somni Group owns the product and the retail channel, synergies compound. That's a different business model than a manufacturer trying to navigate shifting demand from the outside. Moving to the manufacturer side more broadly, this quarter had some significant news that warrants attention. HNI Corporation reported net sales of $1.35 billion, up 125% from a year ago, almost entirely because they acquired Steelcase in late 2025. The revenue is up, but the company reported a net loss of $38.8 million, driven by acquisition integration costs and weaker organic demand. On an organic basis, sales actually declined 3.2%. They're doing the right long-term work, cutting integration costs, targeting $120 million in synergies, but the near-term picture is under pressure. Our house had its highest first-quarter revenue ever, just over $314 million, but net income fell more than 50% to $2 million. Expenses are rising faster than sales, and they ended the quarter with comparable written sales down nearly 6%. The most significant manufacturer story, though, is Bestar. They filed for Chapter 15 bankruptcy protection in U.S. bankruptcy court on May 4th. Bestar is the parent company of Bush Furniture and Bush Business Furniture. The filing cited U.S. tariffs, post-pandemic demand reduction, offshore competition, and cash constraints as the drivers. If you carry Bush product, it is worth checking on open orders and identifying backup options now. There's another story this week that doesn't fit neatly into an earnings report, but may end up being more consequential than most.
Palliser Furniture, a well-known Canadian upholstery brand, announced what it's calling a close and constructive partnership with Moto Motion, a Chinese components manufacturer that has been Palliser's supplier of power mechanisms and electronics for years. The full details of this arrangement haven't been officially disclosed, and messages to Palliser's leadership went unreturned. But Moto Motion's public filings with the Shenzhen Stock Exchange tell a revealing story about who this company is. They generated roughly $470 million in revenue last year, up nearly 80% over 2 years, and were profitable at around $126 million despite challenging trade conditions. They hold over 500 U.S. patents, run their own circuit board manufacturing, and count roughly 28 of the top 100 U.S. furniture retailers among their customers.
The company's stated #1 priority for 2026 is building a more resilient global supply chain. Adding Palliser's North American manufacturing in Mexico and Canada directly serves that goal. They've also recently added a facility in Cambodia and have announced plans for a direct-to-consumer shop-in-shop presence in U.S. retail. This is not a passive supplier stepping in to help a partner. This looks like a strategic move by a company that has been building toward North American market integration for some time. If you carry Palliser, monitor this situation closely. On the tariff front, the picture is mixed this quarter depending on your category. For rugs, things improved significantly. The 50% tariff on Indian goods was removed in February, and at the recent High Point market, rug importers reported strong traffic and renewed buyer confidence. Brands including Jaipur Living, Laloy, Cappadocia Rugs, and Armadillo all described better than expected momentum. That's a real buying window for rug retailers. Landed costs improved and supplier confidence is returning. For the broader furniture import picture, Section 122 tariffs imposed in February are creating ongoing cost pressure. Those come with a July expiration date, but Havertys noted in their investor call that they expect rising vendor import costs, fuel surcharges on container shipping, and delivery fleet costs to weigh on Q2 margins. The July expiration is a decision point, not a conclusion. Don't plan around tariff relief that hasn't been confirmed. Let's close with a bit of data that's relevant to every retailer heading into Memorial Day weekend. RetailMeNot surveyed more than 1,000 U.S. consumers in March and found that 54% plan to shop Memorial Day sales, up substantially from 36% last year. That's encouraging. But average planned spend dropped 70%, from $289 to just $86. More consumers plan to show up, they're just planning to spend less when they do. Outdoor furniture and home goods both ranked in the top categories. Mattresses were on the list, and nearly 2/3 of consumers said they were likely to wait for Memorial Day sales before making a major purchase. The intent is real, but consumers are coming in with a number already in their head, and they're staying close to it.
That means promotional success this Memorial Day weekend is about driving conversion within a tighter budget. Finance offers, monthly payment framing, and clear value stories matter more than high-ticket aspirational displays. The traffic will come. The job is converting it efficiently. Here's the through line from this week. Havertys grew by building services that close higher value transactions. Bob's grew by moving the assortment toward better goods. Somni Group is expanding margin through vertical integration. Moto Motion is building a global supply chain under tariff pressure. The Howard Miller brand, which had announced plans to wind down operations last July, was just relaunched under new ownership, a bet that a 100-year-old heritage brand still has commercial value when positioned correctly. The companies gaining ground in 2026 are not waiting for conditions to improve. They know exactly who their customer is and what they're building toward. That clarity is doing real work in a quarter like this one. Thanks for listening to Furniture Industry News. If this briefing is useful to you, please subscribe. It helps us keep delivering content like this every week. We'll see you next time.